today in Korea.
Leverage we see in South Korea.
South Korea's financial regulator.
Last time, I made a video about how South Korea had become the most profitable stock market in the world. This one is about how South Korea became one of the worst. Last year, the KOSPI rose 76%. This year, it peaked above 9,000 in June, up another 112%. And then, from that peak, it fell 27%. Now, a 27% drawdown is painful, but it isn't historic. Markets do this. What made this one different wasn't the size of the fall. It was happening behind the scenes. Like the US, Korea has a circuit breaker. If the index falls 8% from the previous close and stays there for a minute, the entire market shuts down. Not one stock, the whole exchange. 20 minutes, everybody goes quiet. At 15%, it happens again. At 20%, they close for the day and send everyone home. America's version sits at 7, 13, and 20% on the S&P 500. And in the entire modern history of the US market, it has been triggered on 4 days. All 4 of them in March 2020. Plus once under an older system back in 1997. That's it. A market-wide trading halt in the United States is a generational event. It leads the evening news. Korea has done it 11 times. And it's worth looking at what's actually on that list. The first 6 run from 2000 to 2024. 6 halts in 24 years. And every one of them has a headline attached to it. A crash on Wall Street, an oil shock, the September 11th attacks, the pandemic, twice in 1 week. Every remaining row is this year. 5 halts in 4 months. And the first few still have a story behind them. Trouble in the Middle East, an oil spike, a sell-off in chip stocks on fears of a US rate rise. But the final 2 have nothing. No war that week, no oil shock, no crash on Wall Street overnight, no headline of any kind. On 2 separate days in late June, the Korean stock market fell 8% in a single session and switched itself off. And if you go looking for the event that caused it, there isn't one. That's the part that should bother you. Not that Korea is volatile. Plenty of markets are volatile. It's that a mechanism built for pandemics and terrorist attacks is now being tripped by nothing in particular. Whatever is doing this isn't happening to the Korean market. It's happening inside it. So, what is actually at the center of this? Start with what the KOSPI fell 27% actually means. At the June high, 2 companies made up almost 60% of the KOSPI, Samsung Electronics and SK Hynix, up from around 40% 18 months earlier. So the KOSPI isn't really a diversified basket of a nation's industry. It's a leveraged bet on 2 chip stocks wearing a country as a costume. When people say the Korean market crashed, what they are actually saying is that 2 companies fell and dragged an entire country's index down with them, which narrows the question considerably. Why did those 2 stocks fall? The obvious guess would be that the businesses got worse. No. Samsung's second quarter operating profit was 89.4 trillion won. It is plausibly the largest quarterly profit any private company has ever posted anywhere. Bigger than Nvidia's best quarter. Bigger than Apple's. And on the day it announced that number, the stock fell 9.6%. The next day, it fell another 8%. So the companies aren't the problem. The earnings are real, the demand is real, the technology lead is real. Which leaves a much stranger question. If these are the best businesses on Earth right now, who was selling them? Global funds mostly, but not because they'd turned against Korea. They were selling because the rally worked. Global funds run limits on how much of a portfolio is allowed to sit in any one country or any one stock. It's a risk rule, and it's usually invisible because positions don't normally grow fast enough to bump into it. As Samsung and SK Hynix went vertical, they blew straight through those limits, and managers had to trim, not because they'd changed their minds, but because their own rulebook said so. So over the past year, large institutions offloaded roughly 150 trillion won of Korean stock, with the selling accelerating sharply from early May. So for every share the institutions dumped, somebody was standing underneath with their arms out, catching it. They are 14 million retail investors. The dominant force in Korea isn't foreign institutions, and it isn't pension funds. It's a retail army known locally as the ants. Out of a population of 51 million, Korea has around 14 million retail investors, nearly 30% of the country, and they account for roughly half of all trading volume. In the United States, retail is about 20%, and institutions are 80%. And the ants absorb nearly all of it, a great deal of it with borrowed money. Margin balances hit records. The leverage products sold out on their listing day. So the professionals were forced to sell near the peak, and ordinary Koreans borrowed money to buy what the professionals were dumping. So why would 14 million people decide that borrowing into a vertical market was the sensible option? Because of what the alternative looks like. A sole apartment costs roughly 14 years of salary. Only about a quarter of people in their 30s own their home. When you've been priced out entirely, putting 10% of your salary into a savings account doesn't feel like a slow path to a house. It feels like inflating a hot air balloon with a bicycle pump. So the risk gets taken. But buying shares with borrowed money is not new, and on its own, it does not turn a national stock index into a roller coaster. Something else happened this year. In late May, brokerages launched 16 single-stock leveraged ETFs on Samsung and SK Hynix. Each one promised retail investors twice the daily return of the underlying shares. Even before those funds existed, these were stocks that routinely moved 8 or 10% in a day. The ants looked at that and decided twice the return sounded better still. It is also not as straightforward as it sounds once you look at what happens under the hood. So here is what one of these funds is actually obliged to do. To deliver 2 times a stock's move today, it has to start the day holding twice its own value in exposure. Put in $100 and the fund is carrying $200 of stock. Simple enough. The problem is that the moment the price moves, that ratio breaks, and it has to be fixed before tomorrow. Say the stock rises 10%. Your $200 of exposure is now worth $220, so you've made $20, and your $100 is now $120. You're up 20% while the stock only rose 10%, which is exactly what you paid for. But to deliver 2 times again tomorrow, the fund needs 240 of exposure, and it only has 220. So it has to buy 20 more. Now say the stock falls 10% instead. Exposure drops to 180. You've lost 20, and your stake is down to 80. The fund now needs 160 of exposure, and it's carrying 180, so it has to sell 20. Every day at the close, the fund resets. It buys after the stock has gone up. It sells after the stock has gone down. In a market that only goes up, that is a wonderful thing to own. It compounds you into a fortune. In a market that goes up and down, it is a shredder. And here is the arithmetic that most of the people who bought these things had never seen. Take a stock at 100. On Monday, it rises 10% to 110. On Tuesday, it falls 10%, back down to 99. Over the 2 days, you're down 1%. The fund lost 4%. Not double, quadruple. And notice that nobody was wrong about anything. The stock finished almost exactly where it started. That loss was manufactured entirely by the wobble. Now run that every single day for 2 months in the most volatile large-cap market on Earth. Between late May and mid-July, SK Hynix's actual shares fell about 18%. Twice that would be 36%. The 2 times product on it fell 47%. You can be right about the company, right about the sector, right about the direction, and still be ground down to nothing by the path the price takes to get there. Volatility alone will do it. And then there is what happens when an entire country owns the same product at the same time. Which raises an obvious question. These products didn't appear on their own. Somebody approved selling twice daily leverage on the most volatile large caps on Earth to retail investors. So where were the regulators? A briefing in the presidential office, Lee turned to the governor of the Financial Supervisory Service, the body that had approved these products in the first place, and asked him to account for what the leveraged ETFs had done to ordinary investors and to produce countermeasures. The measures landed on the 16th of July. No new listings of single-stock leveraged or inverse products. A ban on advertising and marketing them. Mandatory investor education raised from 3 hours to 4, now with an exam you can fail and have to resit. And the minimum deposit tripled, a little over $20,000. Which is to say, having built the casino, installed the tables, and let the crowd in, the authorities decided that what the situation really needed was a short educational film and a cover charge. It's hard to say how this ends, but you can get a sense of the direction by watching the people buying the chips. Samsung and SK Hynix look invincible right now, and their earnings are real. But that success rests almost entirely on the capital spending decisions of a very small group of American companies. The 4 biggest hyperscalers have already laid out around $376 billion this year, with the wider industry on track for closer to $725 billion. If the hyperscalers ever begin to ask what all of this actually earns, and suspect the answer is less than we spent, then the first tremor won't be felt in Silicon Valley. It'll be felt in Seoul.